In the annals of corporate history, few narratives resonate as profoundly as the rise and fall of Enron. Once hailed as a beacon of innovation and a model of corporate prowess, Enron's collapse in 2001 revealed the dark underbelly of corporate greed and deception. This story serves as a cautionary tale about the consequences of unchecked ambition and the importance of ethical governance in the corporate world. Enron was founded in 1985 by Kenneth Lay, who envisioned a company that would revolutionize the energy sector. The company began as a traditional energy provider, but under Lay's leadership, it quickly transformed into a complex trading entity that dealt not only in energy but also in various commodities, including broadband and water. By the late 1990s, Enron had established itself as a market leader, boasting a stock price that soared to dizzying heights. The company was celebrated for its innovative business model and was frequently lauded by analysts and investors alike. Enron's culture was one of aggressive growth, driven by a relentless pursuit of profits and an insatiable appetite for market dominance. However, beneath this facade of success lay a troubling reality. Enron's financial statements were increasingly opaque, obscured by a web of complex accounting practices and special-purpose entities, SPs. These SPs were designed to keep debt off Enron's balance sheet, allowing the company to present an artificially inflated financial picture. The use of mark-to-market accounting, which allowed Enron to record projected future profits as current income, further distorted its financial health. As the company continued to misrepresent its earnings, it cultivated an environment where ethical considerations were sidelined in favor of short-term gains. As the new millennium dawned, cracks began to appear in Enron's seemingly impenetrable armor. In 2000, the company reported a significant drop in profits, prompting analysts to question its accounting practices. Despite these red flags, Enron's leadership, including CEO Jeffrey Skilling, remained adamant about the company's financial prowess, dismissing concerns and maintaining the stock price through aggressive public relations campaigns. The company's stock, once a darling of Wall Street, began to falter as whispers of impropriety grew louder. The turning point came in October 2001, when Enron announced a massive $618 million third-quarter loss and revealed that it had overstated its earnings by nearly $600 million over the previous 5 years. This shocking admission sent shockwaves through the financial community, leading to a rapid decline in investor confidence. Enron's stock, which had peaked at around $90 per share, plummeted to less than $1 in a matter of weeks. The fallout was catastrophic. Employees who had invested their life savings in Enron stock faced financial ruin as their retirement plans evaporated overnight. Thousands of employees lost their jobs, and the company, once a symbol of American ingenuity, filed for bankruptcy in December 2001. The collapse of Enron had far-reaching implications. It not only devastated the lives of its employees and investors, but also shook the foundations of the accounting industry. Arthur Andersen, one of the Big Five accounting firms, was found complicit in the scandal, having failed to uphold its duty as an independent auditor. The firm was subsequently dissolved, marking one of the largest collapses in the history of professional services. The Enron scandal exposed significant gaps in regulatory oversight, leading to widespread calls for reform in corporate governance and accounting practices. In the aftermath, the U.S. government responded with the Sarbanes-Oxley Act of 2002, a landmark piece of legislation aimed at enhancing corporate accountability and protecting investors from fraudulent financial reporting. The act imposed stringent regulations on publicly traded companies, requiring greater transparency and accountability in financial disclosures. It also established the Public Company Accounting Oversight Board, PCAOB, to oversee the audits of public companies, ensuring that such a scandal would not occur again. The lessons learned from the Enron debacle are manifold. First and foremost, it underscores the critical importance of ethical leadership and corporate governance. A culture that prioritizes short-term profits over ethical considerations can lead to catastrophic consequences. Companies must foster an environment where transparency, accountability, and ethical behavior are at the forefront of their operations. Moreover, the Enron scandal highlights the necessity for robust regulatory frameworks that can adapt to the complexities of modern businesses. As companies evolve and adopt innovative practices, regulators must remain vigilant to prevent the exploitation of loopholes that can lead to fraudulent activities. The importance of independent auditing cannot be overstated, as it serves as a vital check on corporate practices, ensuring that companies adhere to ethical and legal standards. Additionally, the Enron case serves as a reminder for investors to conduct thorough due diligence before committing their resources. The allure of high returns can cloud judgment, leading individuals to overlook warning signs. Investors should be encouraged to seek a deeper understanding of a company's operations and financial health, rather than relying solely on surface-level metrics. As we reflect on the rise and fall of Enron, it is imperative to recognize that the lessons learned extend beyond the confines of the corporate world. They resonate across industries and sectors, reminding us of the fundamental principles of integrity, accountability, and ethical conduct. The Enron scandal may have been one of the largest corporate frauds in history, but its legacy serves as a powerful catalyst for change, inspiring a renewed commitment to ethical business practices and responsible governance. In conclusion, the story of Enron is not merely a tale of corporate failure. It is a testament to the need for vigilance, integrity, and ethical leadership in the pursuit of success. As we navigate an increasingly complex business landscape, the lessons of Enron remain ever relevant, urging us to prioritize ethical considerations in our decision-making and to hold ourselves accountable to the highest standards of conduct. The collapse of Enron may have been a dark chapter in corporate history, but it also paved the way for a brighter future, one where transparency and integrity take precedence over greed and deception.